Welcome to Asset TV. I'm Laura Keller, and I'm joined today by Loomis Sayles Portfolio Manager, Mara Murphy. She's an expert on constructing a portfolio that generates returns from multiple asset classes. Mara, thanks so much for being here today.
Thanks for having me, Laura.
Sure, of course. Well, define for us what exactly you mean by multi-asset investing.
Multi-asset investing starts with a global opportunity set, and then it's about harvesting risk premia across credit, equity, and alternative investment markets. Ultimately, it's about maximizing a risk-adjusted return. We think you can do that by being flexible and having a tactical approach to asset allocation. It's about harvesting income and managing volatility through a full cycle. Our investment process focuses on a top-down cyclical approach and a bottom-up security selection. And the power comes in combining both of those so that we're generating that diversified income stream and managing through volatile markets, aware of where we can get the best return per unit of risk.
So obviously, Mara, that's a lot of different asset classes, multiple assets, obviously. Tell us a little bit more, why it's important to have a top-down macro approach when having this as a strategy.
Multi-asset investing is focused on generating that risk-adjusted return. The way we do that is thinking about what's happening in the macro landscape. Our asset allocation starts with a top-down macro view of the world, thinking about what's going on in the economic cycle. We put the economic cycle into 4 distinct parts: downturn, credit repair, recovery, and expansion. And each phase of the cycle demands a different risk and return profile. In downturn, as you might expect, it's about staying up in quality, focusing on that quality of income and protecting capital. Volatility is rising and returns are often very negative. As we move to that credit repair phase of the cycle, it's about thinking about rising volatility and rising returns. And really, you can take broad-based risks in this part of the cycle, but often investors are shunning risk because they're still too risk averse from that downturn phase of the cycle. When we move into recovery, volatility is finally falling, returns are still quite strong. And then in the late expansion and expansion part of the cycle, it's about security selection. It's really about managing through rising volatility. Assets are often not as cheap as they had been in earlier parts of the cycle, so it's finding where you can get paid to take that risk at that point in the cycle. Managing through the cycle is a key piece of multi-asset investing, but cycles can persist for long periods of time. So in order for us to be more tactical and be more flexible in our multi-asset investing, we incorporate a concept called GRIT. And it's thinking about growth, rates, inflation, and turmoil, and how each of those 4 macro factors can influence mini cycle phases. Thinking about what's happening with growth. Is it improving or is it declining? With rates, is policy tightening or is monetary policy loosening? With inflation, do we have a reflationary impulse or are we on a deflationary scare? And then with turmoil, what's happening in the marketplace with volatility? Is it rising or are we in a pretty muted volatility landscape? And incorporating all 4 of those factors with GRIT helps us navigate within that economic cycle, and both of those combined are the key macro things that we look at in our multi-asset investing process.
Great, I like it. That's a very clever phrase to make sure you've got all of it really managed well through all the cycles. But you mentioned, Mara, volatility a lot. You're having these different asset classes, so there's obviously multiple ways that you have to manage volatility. How do you do that?
For us, managing volatility is incorporated at every phase of the portfolio construction process and every phase of the investment process. We think about managing volatility at the portfolio level and at the security level. When we screen for income at the security level, one of the ways we screen for income also helps manage volatility and manage drawdown risk. One of the things we look at specifically as a metric is EBITDA growth. If we can focus on companies that are median EBITDA growth and avoid those companies with low or no growth, we can avoid the worst drawdowns. Our research has shown that companies with no growth, no EBITDA growth, or very low EBITDA growth often have the worst drawdowns in that asset class. And so instead, focusing on median growth helps us create consistency of income and stronger total returns with less downside risk. That's how we handle it at the security level. At a portfolio level, there's lots of different ways to manage volatility. We're keeping tabs on all of them and trying to incorporate most of them into our investment process. Some of the things we think about are correlations. How are assets correlated? And are we really getting a diverse income stream in our multi-asset portfolio? It's not just about a static relationship, though. It's about how that dynamic is changing. Are those relationships becoming more correlated in stressed periods, or do we in fact have very different income sources in our portfolio? It's about stress testing. What if rates rise quickly? How would our portfolio stand up? It's about scenario analysis. How would this portfolio do in a historical environment? And we can mirror where we are today relative to history and decide how to position the portfolio to withstand this volatility and create strong, consistent total returns.
I mean, that almost sounds like you'd want to have this obviously all the time in your portfolio, but is there a particular reason why investors should be thinking about multi-asset strategies right now?
We're living in a very uncertain world right now. There's a lot of headline risks, whether it be the trade tariff talks or emerging market volatility or midterm elections, you name it. There's a lot of risks on the horizon and a lot of uncertainties for investors. And we're seeing that in the market performance with volatility rising in most asset classes now. So I think multi-asset investing, particularly today, is very meaningful because the goal of multi-asset investing is to manage through that volatility and provide that consistency of return. And we really think that handling diverse income sources throughout this macro landscape is the best way to navigate that.
Great. Well, thank you so much, Mara, for giving us that great insight on multi-asset investing.
Thanks, Laura.
Thank you. And thank you for joining us on Asset TV. I'm Laura Keller.